Good morning, guys. Welcome back. It is Thursday, the 9th of July, and we have an amazing lineup for you today, starting with the lovely Natalie Corrigan, who joins us again from Theataccounts to talk lots of things, tax and NI. Morning, Natalie. How are you doing?
I'm well. I'm good, thank you. How are you?
Good, thank you. Good. Yeah. So, how have you been since we last saw you? Busy?
Yeah, it's crazy, isn't it? The weeks just seem to go so quickly, and yeah, my oldest son, has gone back to school now, but he breaks up again tomorrow, and it's the summer holidays, and it's just crazy, isn't it? Where is the year going?
Crazy. I can't believe we're nearly halfway through July. So tell us a bit about today. So you're sort of picking up from where we left off last session a little bit.
Yeah, that's right. So the last session, we sort of really went back to basics regarding tax and being self-employed. We talked about when you become registered as self-employed, and we looked at all of the sort of when we look at expenses and all the things that are involved when we start to calculate a tax return. But now we're going to go back to the numbers section and start applying the sort of tax and NI to that profit figure that we have worked out. So it's sort of back to basics again, but looking at the figures a bit more in this session.
Amazing. Natalie, I know you said you were doing slides. I should have asked you, do you want to share them now?
I can do that. I'll probably talk and then share them.
Okay, I sort of have to be here in order for you to share them. I have to pop them on the screen. So yeah, if you just if you pop them up now, I can pop them on for you.
Okay, right. Just bear with me then.
So guys, remember that if you want to interact at all with this session, you do need to be subscribed to our YouTube channel, and then you can ask Natalie any questions. Feel free to ask questions throughout the session, and you can chat with her and ask anything specifically related to this session or kind of tax in general. Natalie is, as we said, from Theataccounts, who are a big accountancy kind of specialising in performing arts, specialising in people who work within the industry. So they're very used to doing tax returns for actors and all kinds of creatives across the industry. So if you have any questions today, Natalie is your woman. She is here for you. But as I said, you do need to be subscribed to our YouTube channel. Brilliant. So Natalie, if I just pop that in there.
Yep.
Perfect. And then that's there for you for the session, and you can use that however you want.
Okay, fantastic. Thank you.
Amazing. All right, guys, have a great session. See you at the end.
Thanks, Rosie. Hi, everybody. So as I sort of said to Rosie, on our last session, we covered the basics of tax, part one, if you like. And now we're going to go into part two, where we can look at the numbers in a bit more detail. We've got some great examples to start going through. So I'll run through those with you. And so ultimately, from our last session, we worked out what that profit figure is, and then we need to say, well, what's next? How does that profit figure determine how much tax and national insurance that we need to pay? So that's basically a summary of what we'll go through in today's session. So I've got some slides, so I'll start working my way through those. If you've got questions, then please add them as we go along. I can't see them at the moment, so all I can see is my slides. So at the end, we'll go through some questions. And I know the last session, I did talk quite a long time, so I'll try and leave us a bit more time at the end to answer any questions that you might have. So let's work through these then. So just a small disclaimer there, it's just important to quickly add that in, obviously, regarding the information that you're going to see on these slides and the information that I'm going to share with you today. Okay, so we are Theataccounts. Those that have not perhaps been to one of our sessions yet. I'll just quickly talk about who we are and who I am. So Theataccounts, it's tax made simple for the entertainment industry, as it says there. And we are an accountant that is set up specifically for the entertainment industry. It's run by Alex, and we've got sort of a really good team now within Theataccounts. And our whole ethos is to make tax simple. We really do pride ourselves on being friendly and approachable. And we specialise in, and we've got a broad knowledge of the entertainment industry now that we can obviously pass on to our clients. We continue to grow, and there's lots and lots of services that we provide. As you can see there, the list, we've got sort of tax returns that we obviously can do, self-employed accounts, registration. So if it's something that last week when we talked about being self-employed and how to register and at what point we register, if you think actually that's not something I want to do myself, we would do that for you if you came to us as us being your accountant. So we can deal with all of that as well. We can deal with company setups as well. Next session, in 2 weeks' time, we're going to talk about limited companies and VAT in a bit more detail. And that's a really good one if you've been self-employed for some time, that you've got sort of friends that talk about being a limited company, and you've probably wondered, well, what's the difference? Is it going to save me money? Is it going to ultimately be more work? What's involved in being a limited company as opposed to being self-employed? So the next session is really good for that. But limited companies is an option, and that's obviously something that we deal with as well, along with sort of payroll. So a real vast array of services that we offer here at Theataccounts if you choose to appoint an accountant to help you rather than do it yourself. But the purpose of today isn't just to sit here and talk about us and Theataccounts and how wonderful we are. It's obviously we do these tax talks to really help people try and understand what is required to be self-employed. That's the purpose of this, to give you that knowledge, give you a bit of confidence, I suppose, in your self-employed journeys. So that's the purpose, and what we're trying to do here is just sort of help. And if there's a point in 2 or 3 years after you've done your own tax returns for some amount of time that you feel, right, that's enough now, I'm earning a certain amount of money that I'm quite happy to pay an accountant, then hopefully you'll remember Theataccounts and get in touch. So that's just a bit about who we are. I've been part of Theataccounts now for some time. I've been an accountant, started my career in accountancy when I was 18, and I sort of studied whilst working. I left and went to Birmingham, and I used to teach accountancy and tax for some time. I've got 3 children, and it sort of suited me better to sort of get back into practice. And Theataccounts is just a great company to work for. It makes accountancy, I suppose, a little bit more exciting. And the reason for that really is our clients that we have. So it's just great. You know, I've got somebody who's involved in Phantom of the Opera and that I speak to, it seems at the moment, on a weekly basis. He rings me up and hi babe, and it's just lovely. We've got a really lovely relationship, and that makes my job and everybody here at Theataccounts, our job, that bit more exciting, because we're dealing with people like you guys. We've got actors, performers, singers, dancers, as you can see there, set designers, directors, stage managers. We even deal directly with agents, magicians, comedians, a huge array of fantastic clients that we're incredibly proud to be involved with. And obviously that just enhances our experience in the industry because of the amount of clients that we have now, which is fantastic. So that's basically our amazing clients. and a little bit about who I am and Theataccounts. And we're going to go on to talk about now tax, okay, and at what point you would be required to start paying tax. Just to recap then on last session, which was a couple of weeks ago now, in case you didn't attend that one, you haven't seen that session yet. In that session, we talked about when is a good point to register as self-employed. So we sort of said as soon as you have work lined up through self-employment, that's the point then you would need to call HMRC and you would need to register as a self-employed individual. They will then issue you your UTR number, which I mentioned quite a lot in our last session, so that unique tax reference number, and that will go through your entire journey of self-employment. So we talked about at what point you become registered as self-employed. We talked about how important it is to start keeping receipts. So perhaps even before the point that you have any work lined up, you may be incurring expenses in preparation for that work. You might have 5-10 auditions before you actually secure any work. You might purchase equipment, you might purchase a laptop, all of those things. So we talked about pre-trade expenses, and that some of those you may be able to backdate and claim some of those on your first tax return. So it's really important, and we talked about that in quite some detail about keeping your receipts, and that means then that you are able to claim those and offset those against your income, and ultimately the figure that you will pay tax on is going to be profit, which is obviously your income minus those allowable expenses. We talked about also your expenses, what you can claim. So that's quite a grey area actually in this industry, and it's not the norm, is it? It's it's not normal that you are able to claim things like beauty expenses and clothing and all of that. So it is different in the entertainment industry, and that is probably the greyest area when it comes to what expenses you can claim on your tax return. So we talked about that in quite a bit of detail, and I mentioned things like what is reasonable to think about wholly and exclusively, and if an expense is wholly exclusively for business purposes, then they're easy, great, we know we can claim those. But we have those expenses as well that have that duality of purpose, and that's when things get in a bit more difficult, and we talked about those and how we would split that. So we also talked about use of home, where you're entitled to claim a proportion of your household expenses, providing that you obviously use your home for trade purposes. So we talked about that as well, and we also talked in quite sort of detail about travel and motor expenses as well, and the options that you've got for that, where you put through the actual motor costs that you are incurring. So let's say that you are putting through your insurance and your repairs and your fuel. There could be that duality of purpose then that would kick in, and you'd need to sort of break that up in what's business and personal. Or you could use a simplified method of just claiming business mileage. That could be another option for you. So we talked, as I say, in great detail about expenses, and the whole point of that was to say, well, this is my income, this is how much money I've earned. You've now got that confidence to say, well, this is what I know is allowable business expenditure, and those will come off that income figure. And then what you're left with is your profit figure. So that's your income minus those allowable expenses. So we've got that, you've done that bit, you've listened to me last week, you've gone through all of your expenses, you've worked out what's allowable, what's wholly and exclusively, what has that duality of purpose, you've extracted from that the business element of it. You've considered use of home. You've perhaps just decided to put them through in your mileage whilst keeping a log of that. So you've done all of that, and then you've come to your profit figure. So what next? What happens to that figure? And how does that figure determine how much tax that you need to pay? Okay, so let's go on then to this tax slide and talk in a bit more detail about that. So income tax, you've got to pay it. Once you know your personal allowance, what's your personal allowance? It's the amount we can earn without paying any tax. So once you know that, it can alter personal allowances. It does start to shrink if you start earning over £100,000. If you earn over 125, it goes down to zero. But most people are going to have that £12,500 personal allowance that you get to earn, if you like, tax-free. Okay, so up to £12,500, we've got zero. Then we go into the next basic rate of tax, which it says here on this slide. So after that, we would fall into the basic rate of tax at 20%. Okay, so any income over the 12.5 up to your 50 then altogether would be at 20%. Okay, then when you start going over that figure, you hit what's called the higher rate of tax. And that is then charged, that element of your income that exceeds that figure then, that falls into this new bracket, that's going to be charged at 40% tax. And then we've got our additional rate of tax of 150,000. So anything you're earning over that amount, you're then going to start paying tax at 45%. And remember, at that point, you start losing your personal allowance and things like that as well. It's common that, especially in this industry, that you may work alongside being self-employed. So if you are being taxed in there, your employment, then we can offset that, or you can offset that tax when we do your tax return, because your tax return is going to be accumulation of all of your income, wherever that might be in the world, all of your income together. We work how much tax you need to pay, and then we can offset from that your personal allowance. We can offset from that any tax that you already paid. So this then just say, as a self-employed individual, you need to pay tax. You will need to pay tax over £12,500 if you still get your personal allowance, and that talks about the basic rate of tax at 20%, your higher rate of tax at 40%, and then we've got additional rate of tax at 45%. And as I say, if you do pay tax already in your job, then that can be offset. We've got some examples that I'm going to run through. I think there's like 7 scenarios altogether where you will be able to physically see these numbers. But at the moment, they probably don't mean very much to you, especially if you're brand new to being self-employed. So these will make more sense as we go along. But as a self-employed individual, you will need to pay tax, and those are the tax rates at the moment for England, Wales and Northern Ireland. If you're a resident in Scotland, they have different rates. Just be wary of that. Okay, so that's tax. That's what you need to pay. You will also need to pay national insurance. So whilst income tax is important, it's not the only thing that you will pay being a self-employed individual. So we've got that profit figure now. Not only will we look at that profit figure when determining how much tax you need to pay, we will look at that profit figure as well when we determine your national insurance contributions. Okay, so as a self-employed individual, you will pay tax like I've just told you, but you will also pay class 2 and class 4 national insurance. Let's talk about the differences between the two. So class 2 national insurance is currently, we're talking about the tax year 1920 at the moment, because that's all the tax returns that we're doing. it's £3 per week. For 2021, it's jumped up slightly to the £3.05 per week. Okay, so you will pay Class 2 National Insurance at, if we're doing your 1920 tax return, at £3 per week. And that's when your profits exceed 6365. However, as it states there, voluntary payments can be made if your profits are lower. And we're going to talk about that again in a bit more in detail shortly. It's just to sort of say that your Class 2 contributions, they count towards your state pension, your employment and your support allowance, your maternity allowance and bereavement support there. So what does Class 2 pay for? It pays for those things. It's you paying into your benefit pot. That is what it's doing when you pay your Class 2 national insurance. It's not just Class 2 that you pay as a self-employed individual. You pay your Class 4 national insurance. Now that is payable at 9% on profits when you exceed, your profits exceed that figure 8632. There's also a higher rate as well, the 2% then on profits over 50, which stays the same. I believe the threshold for the 2021 there for Class 4 jumps to 9.5. So you get to have 9.5 at 0 if you like, and then anything after that is at 9%. Class 4 does not contribute towards any benefits like Class 2 does. Class 4 is basically, unfortunately, just another tax. That's what it is. You're probably thinking, well, okay, how do I register to start paying national insurance? Well, it's once you are registered with HMRC as a self-employed individual, you will be registered. That registration will cover both tax and NI. So you're registered for your tax and NI at the same point, really. It could be, and quite a few people sort of mention this to me, that you, if you are working as well as being self-employed, you might well be paying some national insurance through your employment, and that's when things get a little bit more tricky. So if you are paying sort of the maximum Class 1 national insurance through your employment, then you may not need to pay some Class 2. So it's always worth sort of at that point getting advice from HMRC or from an accountant at that point. So things can get a bit tricky if you are employed as well. So let's just summarise then. So you don't just need to pay tax as a self-employed individual, you're going to pay national insurance as well. You're going to pay Class 2 national insurance, which is set at £3 per week for the 1920 tax year. You will only need to pay Class 2 national insurance when your profits exceed that threshold, 6365. However, you can make voluntary contributions, and I'll talk about that in a bit more detail shortly of why you would want to pay voluntary contributions. What does your paying into your Class 2 pot, what is it doing? What are you paying for? It's going toward pensions, employment support allowance if you should ever need it, and maternity allowance should you ever need that. So it's important to pay into that pot consistently so that you can get those full benefits if you need to. As I said, you also need to pay Class 4 national insurance. That is only payable when your profits, self-employed profits, exceed 8632, and that's payable at 9%. That is just another tax, as we talked about there. Okay, so another deduction that could be repayable through your tax return might be a student loan. So if you have had a student loan, you will know if you're on plan 1 or you're on plan 2. And that's important to know which plan that you're on, because that will determine as and when you start repaying some of that loan back. Okay, so we've got here, excuse me, some water. So if you do have a student loan, you will start making repayments of 9% through your tax return when your profits exceed a certain figure. So for plan 1, repayments will start when your profits exceed 19,380, and plan 2 when your profits exceed 26,568. There's also a postgraduate loan, which is slightly different. So if you've got that one, then that's 6% on your is repayable on your taxable income when that exceeds £21,000. So something to bear in mind: if you've taken out a student loan, you will know when you've took that out how it works. You may have forgotten, but it does form part of your tax return, and that's how you will start paying it back, is through your tax returns, and that will work out, and it will be based on the amount of profits that we are putting in that tax return in each tax year. As I say, we've got an example, I think it's scenario 7 in a bit, where we will talk about and look at an actual example of when student loan kicks in. Okay, so we go on now to the numbers section, which is the bit that I suppose I love. As accountants, we love numbers. And as I said, let's just quickly summarise again, because I worry that we go through this so quickly. It's something that I do day in, day out. And it's hard when you're just staring at a laptop like I am now to try and engage and get it interesting for my audience. So let's just recap. So session 1, we talked about at what point to become self-employed, and we talked about expenses and all of those things. So ultimately determining what your profit figure is. Okay. I've talked about now in this session, we've got that profit figure. What happens to it now? When and how does tax and NI get applied to that figure? And that's what we're going to talk about in these scenarios now. And I'm going to show you different examples of how much profit somebody has made, and therefore what they are then liable to pay and at what point. Okay, so on every scenario, we've got our tax rate box here on the left. So for 1920, we've got our personal allowance. Remember I talked about that you get that personal allowance. Most people get that, the £12,500, where you can have that amount without paying any tax on it. When your profits start exceeding that figure, then you're going to start paying 20% tax on, and that does change. Remember, I've shown you that the more that you earn, the more tax that you're going to pay. We kept it simple for all these scenarios where it's only the 20% tax applied, but just be wary of that. If you do land this great new role and you're earning really, really good money, and as I say, we've got a vast array of clients here at Theataccounts, and some people earn really good money doing what you do, and that must be fantastic because it's something that you love and that you enjoy doing, and there is the opportunity there to earn good money doing what you do. But we've kept it simple in all these scenarios, so we're only ever applying the 20%, but obviously, as you were aware, it does alter. So we've got there your tax, and then we've got your class 2 national insurance. Remember I talked about that. So that's your £3 per week when profits exceed 6,365, and class 4 NI, which is payable as a self-employed individual at 9% on profits exceeding 8,632. Okay, so let's have a look then. As I say, there's 7 scenarios in total. Each scenario will introduce a new element to the tax return, including the dreaded payments on account as well, that I'll talk about in a bit more detail. And as I said, we've got a scenario, I think it's the last scenario 7, that we introduce repayments of a student loan. So bear with me while we go through all of these now. So let's have a look then. Scenario 1, let's say this is Joe. So Joe, his self-employed income for this year, 1920 tax year, I'm doing his tax return at this point now, and his income that we've added all up for that period of time, April 19, April to April 20, his income total from self-employment is £6,500. Now, Joe has attended in the past one of our tax talks, and he has been able to work out his expenses. So he's got some, let's say, agent fees in there. He's got professional subscriptions. He's got some travel. He's got some phone, and he's looked at that duality of purpose in there. Internet costs, and those for the tax year amount to £3,000. That's the amount of his expenses. So in order for Joe to be able to receive £6,500 worth of income, he's had to spend £3,000. Okay, so they're allowable expenses that we deduct off. So that's leaving Joe with self-employed profits of £3,500. That's the figure that we pull through. This is the magic figure here. So £3,500 gets pulled across now to work out, well, what does Joe, we know what his profit is, what does Joe need to pay? Okay, so profit here, £3,500. He's well within his personal allowance. He's got £12,500 there that he has got to use, and he's well within that. So as you can see in scenario 1, Joe has nil tax due, no tax to pay. Joe, as you can see from the self-employed profit figure there of £3,500, is actually well under class 2 threshold. So the class 2 threshold is 6365. He's under that. He isn't required to pay class 2 national insurance. He isn't required to pay class 4 either, because his profit figure is under that. So why are we saying still pay voluntary? We would always advise our clients, and I'm advising you now, still continue to pay your class 2 national insurance. For the small amount that it is for the year, it is worth you paying it so that you are regularly paying into that pot, so that, as I've said, that you are therefore entitled to those benefits that I mentioned. So if you, especially ladies, 5-10 years time, you have children, if you have shown that you've regularly contributed into that pot, or at any point, then it's going to be beneficial to you, that you therefore can claim your full maternity allowance. If you don't, there'll be gaps, and there is a possibility to fill those gaps. I'll talk about that in a bit more detail shortly, but ultimately it's better just to avoid that problem and just continue to voluntarily pay that class 2. So Joe listened to my advice and has ticked that box to pay that class 2 voluntary NI, so that he's paying into those pots for his pension. So we summarise then for Joe for the tax year 1920, he has £159 to pay for his class 2 NI. Right, let's have a look at scenario 2. So similar here, the only difference that we've got now is class 2 NI now is becoming compulsory. So there's been an increase in Joe's profits, as you can see, and now Joe has got a choice whether he pays class 2 or not. His profits has exceeded that 6365. He has to pay the £159 there. So you can see there that we've calculated, so exactly the same. His profits have increased, however, he's still not needing to pay any tax, but he's got to pay that £159 there for his class 2 national insurance. Let's go on to scenario 3. Here we introduce class 4. So you can see that Joe, we've got that self-employed income there of £13,500. He's had a better year now. So we're looking at his figures. He's increased, he's got more work, which is fantastic. And he income totals for this year £13,500. He's got his self-employed expenses, so we talked about those. He's worked out how much of those expenses he can claim, how much are allowable, that duality of purpose, wholly and exclusively, and he's got those expenses that he's deducted, and now we've got a nice profit figure here of 9.5. Okay, so you'll see the difference here. We've pulled that £9,500 now over here. We take off that personal allowance. So we've got £12,500 that we are taking off. As I say, that can change depending on the tax year, but for 1920 it's 12.5. And therefore there is no tax due. Joe doesn't need to pay any tax. His class 2 NI here is compulsory. He's got to pay it. That £9,500 has exceeded over here that limit we've got here for class 2, which is a 6365. So he's gone over that. Now we look at his class 4. So is any class 4 payable? This is the point where we go, okay, we need to do a bit more work. We need to work out and calculate if any class 4 is due. So we take that self-employed profit figure of 9.5. We minus off the amount, if you like, he gets at 0, which is 8632. And that's the figure for the 1920 tax year. And then the difference, as you can see there, the 868, so that proportion of his profits that exceeded the threshold only, the 868, we're going to charge that at 9%. So he needs to pay on that income alone, just that 868, he needs to be paying 9% class 4 NI on that. So that's the £78.12 that we've worked out. So the total amount that Joe needs to pay on the 31st of January 2021 is £237.12. We talked about before how a tax year runs from April to April. So we've got our tax year that starts on the 6th of April and runs to the 5th of April. Now, we've got, once that tax year is finished, you have got all of that time to be able to submit a tax return, okay? You don't need to leave it till January. That's the crucial part here. You've got all of that time, once that tax year is finished, to be able to submit that tax return. And the earlier that you do it, the better it's going to be for you. You're going to understand your tax liability earlier and you can prepare for that. I have so many clients that come to us in January who leave it till January because often they're just so busy, and that's actually changed at the moment because people have had a lot more free time and they've utilized that time efficiently, and they are doing their books and getting information to us earlier than we would normally have seen, which is great. And that just gives us time then to be able to prepare a tax return. It gives you time to be able to do it and work out what you owe in January. You don't need to pay it still until January. So you could submit your tax return today for the 1920 tax year that has just finished. You could do it now, but you would still not need to pay that liability, if there was some, until the 31st of January by midnight 2021. And I think perhaps some people think that they have to pay it as soon as they submit it. That's not the case. You have got longer to do it. And it just is easier, isn't it? It's something that is better to be prepared for, especially when payments on account can't kick in. So summarise scenario 3 then. We've seen the introduction on this one of class 4 being due, and we've got the total amount that Joe now needs to pay for 23712, that even if he submitted that tax return today, he wouldn't need to pay that money until the 31st of January 2021. Okay, right, so our next scenario now starts seeing tax being due. Okay, so this is at the point, it's quite interesting to see this now. You can start visualizing this for your own circumstances. This is the kind of level of income and profit that you need to be receiving in this tax year to be able to then start paying any tax on. So it's quite good to look at those figures and take note of those figures. We've had it the other way, where we've had clients that have been really good, and I know I need to pay 20% tax. I've looked on the Gov website, I've Googled it, I know that I need to pay 20% tax. And then they've been putting money aside every single month of their income that's gone into a savings account or whatever. And then actually, when we come to it, we say, well, actually, it's not on income, it's on profit. So you've got all of these expenses. And then have you considered your personal allowance? And actually, that individual might not need to have paid any money at all they don't owe any tax. They might just end up paying that voluntary NI. And they've been struggling for months, living on beans on toast for no reason, really. So it's always good to have an understanding of those figures. So understanding what your tax return is and how we calculate and expenses and all of those things. And then when you have got that profit figure, where do you go from that point? What do I need to pay? What am I likely to pay in the future? And this is giving you an insight into that, really. So scenario 4 now, we've got income of £15,500. And at the beginning, when you're in the industry, it's hard, and you might have work lined up for a couple of months, but then nothing after that for a period of time. It's very up and down. It's a very hard industry to work in. But as I say, it's such a rewarding industry to work in as well, both financially as well as doing a job that you love. So let's talk about Joe again here in scenario 4. So Joe's income, let's say he's done some voiceover work and he's got income of 15,500 now. His expenses are pretty low in comparison to previous years. Quite common. You might have more expenses as you begin and you're buying equipment and all of those things that you need to start your business. Now he's just got expenses of 2,500, so his self-employed profits is 13,500. And remember, that's the magic number. That's the one that gets pulled across to the tax return, and that's the figure that we're going to start applying these tax and the national insurance contributions to. So Joe, 13,500. As you can see now, he has exceeded that personal allowance limit. Okay. So he still gets his £12,500, that part of his income, at zero. He doesn't need to pay any tax on that first £12,500. But the £1,000 that he's exceeded, the £1,000 he's gone over, we then need to charge that at 20%, and that's the tax that's due on the difference on that £1,000 there. So that is then charged at 20%, hence £200. And then we work out his class 2 and his class 4. So we look at that profit figure again of 13,500. He's exceeded that threshold there of 6,365. He's over it. He needs to pay that class 2 national insurance that's just set, regardless of the amount over, it's set at that £3 a week for the tax year 1920. As I said, it jumps up to £3.05 for 2021. So £159 goes in there. It's then we look at class 4. So we say, right, as a self-employed individual, you've got to pay class 4 as well. So we look, as you saw in the previous example, number 3, we can calculate that. We take that profit figure again. We take off the amount he can have, if you like, free without having to pay any the 9% on. We take that 8,632, and then the difference is then 4,868 that we've then charged at 9%. So Joe now, so he's earned income's 15.5. He spent 2.5 on all his allowable expenditure. His profit is 13.5. So based on that profit figure of 13.5, Joe needs to pay £797.12 to the taxman on the 31st of January next year. So that's here, scenario 4. We've got tax, class 2, class 4, B and J. Scenario 5 then. Here we see PAY income and some tax that has already been paid at source. So this is when things get a little bit more complicated, I suppose, and perhaps more relevant to you guys if you are working alongside being self-employed, which is incredibly common. Lots and lots of our clients do that. So we've got our table there as normal on the left. Let's have a look here for scenario 5, and let's talk about Joe again for this example. So Joe has been working, doing his self-employed work, and he's done well. He's had a really good year so far. £18,500 has been his income. But Joe also has been working part-time in his family's, let's say, cafe, something like that. He's been helping out and he's been doing some extra work there. So he is employed by that cafe, and that is PAYE income. He's an employee for the cafe. So he's been working there as well as being self-employed. So this is when, as I talked about in a tax return, we need to put together all of your income into that tax return to work all the figures out. So he has got profits just from his self-employment. Now let's just talk about that. We've got self-employed income of 18.5. His allowable expenditure is 4.5, which is giving him profits of 14.5. And that's the figure that's getting pulled and shown as his self-employed profit there. Here we go on the right. He also has from the CAF, as I mentioned, £3,500 for that tax year. So his actual combined income, when we just talk about the self-employed profit and the PAYE income, is £18,000. Okay, so he's had a good year. He's exceeded his personal allowance here. So we take away, we combine the two, and when we take away the personal allowance, we take it from them both. So we take that £18,000, we're deducting from that the £12,500 personal allowance, and the difference, the 5.5, is the figure that we're going to be charging tax on at 20%. And that's where that figure's come from. The £1,100 is the 20% tax he needs to pay on the difference of those combined incomes. Now, it's got here that actually Joe has already paid some tax, and he paid tax at source. He paid it the CAF. So the CAF run their payroll monthly, and he's actually ended up paying some tax through that employment. And how does he know that? You would normally be issued your P60 at the end of a tax year from any employer, which will summarise your income. It will summarise all the deductions that you have suffered in that tax year. So he knows that on there he has paid some tax already, and £700. More than likely, if you do your own tax return, that because employers have a duty to submit monthly, to most cases they submit monthly to HMRC. HMRC have already got a record, more than likely, of what you've earned through PAYE, because it's instant. So that will go through as and when you earn it and as you're paid. So if you're paid on a monthly basis. So when you perhaps log in to be able, your government gateway, well, if you're doing your own tax return, you're more than likely see those figures already there. And when we have access as clients, as an agent for working for our clients, we can log into their HMRC account for our clients, and we can see that actually they already hold that information, and we're just checking that P60 to what they've got. Sometimes there can be errors, there could be differences, always worth checking, but more than likely it's already going to be there, and they're going to see that, and it's already, you know, recorded. So we deduct from that tax that Joe needs to pay, the £1,100, we can deduct from that £700 that we have potentially picked up from his P60, or as I say, perhaps it's already on his HMRC account. So actually, he doesn't need to pay the full 1,100 because he's already paid £700, and we show that on the tax return. So the total tax, as you can see there, then is the 18,000, which is the combined profit, self-employed profit, and his income for the year from the CAF, which is 18. We take off that personal allowance, the amount of income he can earn without paying any tax on. That gets deducted off. The difference then of 5.5 is taxed at 20%, but we can deduct £700 because he's already paid that. So that's £400 therefore that he owes left in tax. He still just needs to pay that 400. Class 2, we only ever look at class 2, remember, for the self-employed profit. So we look at that 14.5. He's way over, he's exceeded that limit, but we'd probably, as I say, pay it anyway, voluntary. And then we look at the class 4 as well, national insurance. So we look at that 14.5, we minus off that 8,632. And then that is how we've calculated at 9% on those profits that are left. We have calculated the 52812. Now, as I've said, we can do this at any point once that tax year has finished. And you can see now that he needs to pay a balancing payment here now to HMRC by the 31st of January 2021 of the £400 tax, his class 2 and his class 4. The total of those three figures is the amount he'll need to pay in January. But he can submit this at any point once that tax year is finished, but still not need to pay for it until the 31st of January midnight 2021. Okay, so that's scenario 5, when we see the introduction of PAYE income and tax being already paid at source, and that's what we call when we pay tax when you're employed at a job. So that's scenario 5, which is probably the most relevant to most of you. So let's have a look at scenario 6. Now we see here the introduction of payments on account. Okay, we also see that payments on account kick in because the tax that is due for Joe this time, along with his class 4 NI only, those two figures have exceeded £1,000. And what that means then is payments on account kick in. If you wasn't on my last session, you might not know what I'm talking about. And it's something that I deal with actually quite a lot, again in December, in January, with clients who have been self-employed for some time actually, and they're still totally unaware of payments on account, or they've come to us as later on, and they're just something they wasn't aware of. So basically, payments on account is when you start making payments towards your next tax return or your next tax year. So you're paying tax in advance. And the purpose of that is that the first year is always going to be the biggest hit. So for Joe, this will be his first year that payments on account kick in. But the purpose of it is that by the following year, when we work out what tax that balancing payment is due to HMRC, essentially, if you've paid payments on account and you've made those two payments, and I'll talk about the dates of those shortly, if you've made those two payments, you will be able to offset that payment off your tax bill, so that actually you've paid perhaps a good chunk of that tax bill, and therefore you just need to pay the difference and then the next payment on account for the following year. So that's the purpose of it, and it's something to just be aware of, like this scenario 6 shows here. So I'm going to run through this. I'm going to talk through all the figures again, and then we'll look at those payments on account again and talk about those in a little bit more detail. So we've got Joe now, and He's got some great self-employed income here of £20,000 now. It's going to gradually increase throughout these scenarios. He's worked out his self-employed expenditure. He's worked out what he's allowed to claim against that income, what is allowable expenditure, and that has given him that self-employed profit figure of £15,500. Now that's got pulled here into the tax return, and that's the figure that we're playing with. That's the figure that we are looking at. So personal allowance, he's allowed to earn £12,500 of that profit he can have without paying any tax on. So we deduct that, and he's just going to pay tax on the difference. So the difference between those figures is what we've applied the 20% tax on. We've got his class 2 going in. That set figure, he's exceeded it. It's gone in, fine. Class 4, we've worked out. We've done that in quite a few, all of these examples pretty much now. The difference between that profit figure and the 8632 of class 4, that threshold that you get 0, but anything after that then is at 9%. We worked out at 61812. So he owes Joe for this, in this example, he's got £600 tax. He's got his class 2 NI going in, his class 4 NI, and therefore those all added up together have come into 137,712. So that's the amount, his balancing payment that is due for the tax year 1920. That's how much he's due to pay. However, we have got that if we add up his tax due of 600 and we add up the class 4 NI of 61812, those two figures added together come to 121812, which exceeds the £1,000 that I keep talking about. So he's exceeded it, which means automatically payments on account are going to kick in. So not only does Joe now need to pay what he's due to pay, the 137,712, he needs to start paying a further 50% of what they expect him to earn in the following year based on this year. So it's just a calculation of those two figures divided by 2. It's therefore payment on account 1 is at 60906, payment on account 2, again the same figure, and that's how it's worked out. It's based on the year that we've just done. So actually, Joe doesn't just need to pay in January his balancing payment of all the tax NI and NI 2 and 4. He also needs to make his first payment on account payment as well. He needs to pay that too. So actually, Joe needs to pay in January now. I'm going to shock Joe, because I'm going to say to Joe, I know you've worked out what you think to pay. You know a little bit. You've been doing this for some time now, but actually, you've got the 137,712 to pay, but you've now got to pay 50% towards next year as well. So his amount due on the 31st of January now is jumped up, including that first payment on account he needs to pay, to 198618. So it's the first payment on account figure plus his balancing payment. So he's like, oh, okay, well, I've been putting money aside, and now you're telling me that my tax bill is just over £600 more than I thought it was going to be. Yes, Joe, I am telling you that. Now, that's a bit of a shock if we're doing this on the 30th of January. That £600 is a lot of money to find in a day. So another example why I can't stress it enough that it's just going to help you. It helps us. It helps yourself to just do it earlier, because then you are more prepared. I have it, as I said, that people over prepare because some people panic. Anything to do with HMRC and tax, are scared. Oh my God, if I don't pay my tax bill, I'm going to prison. All of these people panic. So you get the other end of the spectrum where people are the opposite and they really do panic, and, as I say, probably put too much aside. So knowing your tax position early and getting it done and getting it out of the way is just one less thing to worry about, and you can go on doing what you do. It's just an unfortunate part of being self-employed that most people come to me and say, I'm creative, I'm an actor and all, and that's fab because I'm rubbish, this is bad enough. talking to a laptop. But you know, I wouldn't have the confidence to stand on stage and well, I can't dance or sing either, but you know, I just don't have the confidence to do that. And you're great at what you do, and you might be like, well, numbers are just, I hate them, it's just something I don't even want to think about. But it's something you've got to think about. Numbers and tax and being self-employed, it's important. And you know, the more that you have an understanding, you don't need to have a huge understanding of it, because you could hire an accountant if you want to, but an idea of what's going on, what is allowable expenditure, what point you register to be self-employed. When you've done all of that and you've done your first year, fantastic, you've earned money now. What do you do with that money? What am I going to have to pay in tax? What am I going to have to pay in January to the tax man? The more that you know about this, it's going to be less of a headache. And so many clients do come to me saying, I just hate tax, I don't want to think about it, and they just push it aside. So an understanding of it is better for you, and being prepared, even at this point. It could be, if you're just starting your self-employed journey, it could be 2-3 years, maybe more, before you even have to think about payments on account. But at least, hopefully, I've just given you a little insight into it, that you now are aware of it and think in the back of your mind, I remember her telling me about payments on account. I remember that you might have to pay some of next year's tax in advance if my income exceeds a certain amount. I'll be aware of that, and I'll be aware that this is the kind of figures that I'm going to need to be earning for that to start happening to me. And it's just being a bit more knowledgeable about that, and that's what I'm trying to do, just give you a little insight into the figures and the numbers and what they all mean, really. So just going back to Joe then. So I've shocked Joe and said, no, Joe, I know you've done your little bit of calculation, but actually payments on account have kicked in for you now this year because you've exceeded that level, and you need to pay the 1986.18 on your 31st of January, but also you need to pay your second payment on account, and that is due on the 31st of July every year. So you've got 2 tax days now. So you might have heard people say they've got a tax bill to pay in July, and that means that it's this second part of payments on account. At the moment, because of COVID, if you are already aware of payments on account, it's something that you've been paying, you can defer that. It's automatically deferred until January, but you must pay that, any tax that you owe, by the 31st of January next year. So it's just something to be aware of. It's the biggest hit in the first year, because you're paying what you owe plus more, but ultimately the following year you will have your tax bill, and then you'll have those payments on account that you've made in January and July to offset against that figure. You will just pay any difference, and then you're just going to pay your next payment on account. So it gets a bit simpler. The only difference to that is obviously payments on account are set on the year. They're estimates. They're based on what you've previously earned. So if Joe goes away next year for the 2021 tax year and he's earning double this amount, his payments on account weren't set at the right figure. We wouldn't go back and change them, but you need to be aware, well, Joe would need to be aware that actually when we offset those payments on account, when we do his tax return for 2021, it's not going to be enough, and there's still going to be quite a big chunk of tax to pay. And then likely the following year, you're going to have a larger payment on account calculated, because that's based on those new higher figures. So just be wary of that. We do have options to change payments on account, especially at the moment if people have just got no income at all coming in. So those tax returns that we are currently doing for 1920, it's still a little bit early because we're only, you know, April, May, June, July, 4 months into that new tax year. So it's still earlier than we would normally look at. We would normally start amending them more November time. But it's something that can be amended if it's right to amend. So if you're saying, actually, these are being set too high, I'm never going to earn that sort of income, and that's quite relevant in this industry. It goes up, it goes down. Actually, we do have the option, or you have the option, to lower those payments on account. However, important to know, if you lower them too much, and actually it was wrong to do that, HMRC could charge you a small amount of interest for that. So just bear that in mind as well. Okay, so final introduction. I'm doing it again where I'm rambling on. Is our final scenario. Sorry. Here is me just finally introduce an example here with student loan being applied. So I mentioned this before. You will know if you have a student loan, and you would have known roughly what is involved with that student loan and at what point you start paying it back, but you may have forgotten. It might have been many years ago. So repayments will start on that student loan. It's something that we incorporate within the tax return when you start earning above a certain level, and that all depends on which loan that you have, whether you have the plan 1 or plan 2. So it depends on those. So our tax table on the left now just sees the introduction of those student loan figures there. So that's relevant, obviously, now to this scenario. So let's have a look at this one. So we're going to use Joe again. So Joe's income now for this example, scenario 7, he's got some really good income again, a nice increase again. He's now at £36,000. He's got expenses of £6,000, and therefore the self-employed profit is £30,000. That, as I've said all along, that's the figure, that's the magic figure that gets pulled across here to the tax return part, and this is the bit that we start applying all of these tax and NI to. So we've got the £30,000 there going across. He gets his personal allowance of £12,500. So we know that of that £30,000, Joe can have £12,500 of it at zero. He doesn't need to pay any tax on that amount. And on the rest, the £17,500, he needs to pay tax at 20% of that, which is where the £3,500 has come from. We have got his class 2. He's obviously exceeded that threshold then of 6,365. So we've got that coming in. We've got the class 4, which is a calculation again, where we take off the profits that exceed. We'll take the profits that exceed the 8,632, and then we are charging that, the difference then, at the 9%, and that's where the class 4 NI amount has come from. So now we've got tax, class 2, class 4, but we've also got a student loan. So Joe has reached a level where he needs to start paying some student loan now. Okay, he was on his plan 2, and he now, you can see in this year, because his profits are at a good level, HMRC, through your tax return, you need to start paying back some of the student loan. So you will only pay it on the amount where you're exceeding, as it says, your profits exceed that threshold of 26,568 for plan 2. So we've took the £30,000 self-employed profit, we've minus from that the 26,568, which is the allowable amount. It's anything over that, then you need to start paying. So the bit that he's gone over, the 3,432, that's the bit that we're going to then charge at 9%. He needs to pay 9% on that profit, the income that's exceeded that threshold. So all of those together, I mean, look, now we're getting into some bigger figures now. So actually Joe needs to pay some big tax. He's got his class 2, he's got his class 4, he's got some starting stocks to pay now, some student loan repayments. So all of those together actually add up to 5,891, which is quite a big amount. That's quite a hefty tax bill. And as I said, it definitely exceeded your tax due, and the class 4 has well exceeded that £1,000. So obviously payments on account have kicked in again here. So I've got the horrible job of telling Joe, because he probably knew about accounts or forgotten about them or whatever. It's been a long time since it's been relevant, and that you owe 5891 for your balance in payment for what you've earned in 1920, but you need to start paying some payments on account ready for the following year. And those have worked out there. You can see those two figures, the tax added with the class 4 NI divided by 2 has given us those two figures. They're just estimates, they're based on this year. And actually that will jump up, increase the amount that he owes on the 31st of January. It's not the 5891 now, he owes 8602.56. So that's increased that, that's quite a big jump. And he will also need to pay on the 31st of July the 2711.56. So he's got those two payments on account here to pay, along with a large amount of tax, class 2, class 4 and student loan. So it's quite a lot in this one. It's a bit more complex. Please don't be, I do a lot of these now. I did a tax talk last Friday, actually, I think it was, to some graduates, musical theatre graduates, and you know, it's such a lot of information to take in, and it can be a bit overwhelming, and that's not what I wanted to do. I'm trying to, as I say, give you a little insight into how we get those figures and how we do them. Some people don't want anything to do with it, they don't want to know about it, and other people, when we send them their tax returns, they're on the phone and they want to run through these figures, which is great because I can do this, the bit I love, and talk and explain where we've got all the figures from. So, you know, people are very, very different, but ultimately it's just important to add, and I've said this, I think the last few sessions that we've done, the tax return is your tax return. It's your responsibility. And even if you appoint an accountant to do it for you, we would never submit that tax return. It ultimately goes to you for approval. It's your tax return. The responsibility is with you. So a small, you know, a good understanding, I suppose, of those figures, what you're paying, is going to stand you in good stead, because it's ultimately your responsibility. It's your tax return, and going forward, as I say, even if you appoint an accountant, the responsibility is with you, and up to you to check that and to make sure that it looks right. You know, does that profit figure look correct? Is my income roughly what I think it should have been? Are those expenses enough? Are they not enough? Are they too much? Why are they more than I thought they'd be? All of those questions, but it's good to think and look into those, and have a good understanding of, oh my God, I've talked again, of things. So I think that was my last scenario. Probably go on to some questions. I've got our contact details there. I'm going to stop sharing my screen now so I can see some questions now. So let's stop sharing. Escape out of this. Okay, so I have got some questions here that I will run through. Thank you all for listening to me. Oh, there's some lovely comments. Let's have a look then. So, hi Rachel, first of all, your questions come through. So hello Natalie. If one of your self-employed jobs has already paid the tax for you, do you need to still declare this when doing your tax return? Sorry if this is still a silly question, thank you. So which scenario was that? Let me go back. So I think it was scenario 5. No, yeah, scenario 5. So the answer to that is yes, you still need to declare it on your tax return. So we looked at that example with Joe, didn't we, on scenario 5, where he worked at the cafe. and we still combined all of that income together, and we still shown on there that actually you paid £700, wasn't it, of tax at source. So you still need to show that on your tax return. It might already probably be there, as I said, that HMRC will probably already have a record of that income that you have earned through your PAYE, and therefore as soon as you start putting those figures in, it will come up. But yes, your tax return needs to include all of your income and obviously any tax that you still need to pay, and they'll work that tax calculation out for you as well, but it does need to go in. Thank you so much. So I've got another one here. So Yvette, hi Yvette, hope you're okay. Louise has put thank you. Oh, that's nice. Thank you, Yvette. Back to Yvette's question. Thank you, Natalie. Does senior 6, I think she means scenario 6. Yeah, there's another. Yeah, she does. Scenario 6. Oh, hang on a second. It's disappeared. Just scenario 6 also apply as I am receiving my work's pension and now working self-employed. Okay, so I think you mean about payments on account then. So I don't know. So I think that's what you're trying to say. Scenario 6 was the payments on account part. So your pension is obviously paid into your pension pot, which if you're employed, then you can obviously pay through that. Self-employed is separate. If you are going to exceed that, you're still going to need to do your payments on account. Okay, so we've got some questions from Melissa here. Hi, Melissa. Just thinking forward to next year, do you happen to know how claiming universal credit or any government help, obviously such as the grants, will affect our tax return? Thanks so much for this. Yeah, we did a great, our first session was actually COVID and all the things that is to do with COVID. So some benefits are taxable and some are not, okay? So it depends which one it is, first of all. It's something that you need to obviously declare and include. And the grants are classed as taxable income, so they will be incorporated within your next tax return and shown as income and therefore taxed in a certain way. You'll still have your £12,500 tax allowance, so you'll have your grant income and you'll have any other income, PAYE, and it all gets compiled. You know, we looked at that in scenario 6 and 7, didn't we, where everything gets put together. Those would just form part of the tax return as income, and we will tax those accordingly. The grants are taxable. Yvette, hi, hello. Yvonne, thank you. You're welcome. Rachel, thank you, Natalie. I think that's it then. So I've answered that one. Rachel, Louise, Melissa. I think. Hi, Rosie.
Hi, what a great session. Oh my gosh, struggling to speak. Natalie,
the more that you do, you think, oh, it'll be easier, but it's still like you're talking and then it's really hard because you kind of lose your train of thought because you're just staring at a laptop.
Just talking to yourself for hour and 20 minutes.
Yeah, I know, I can talk. So yeah, hopefully it was a good session. Our next session, Rosie, I know I mentioned this before, we're going to look at limited companies and VAT. So that's more appropriate if you are already self-employed or have been for some time. So that's quite a good one then.
I have a very quick question, which you might have covered already, but obviously the government have just axed or cut down VAT to 5% for leisure industries. Does that include actors?
I don't know is the question to that, is honest answer. It was obviously only yesterday. We have to wait for full guidance, and I've got a meeting actually this afternoon where we all come together and discuss this. So yeah, it's quite specific, isn't it? I saw the announcement yesterday, accommodation, and I do know that sort of pubs aren't included and alcohol sales aren't included, but yeah, we, as I say, at the moment, because it's just released, I'm waiting on the full guidance, but we've got our email, so hopefully when we've had our meeting and catch up later today, anybody who does need to know, send me an email.
Yeah, fantastic. And then we'll be covering that anyway, I guess, in a
couple a bit more. It's so difficult because things are changing so quickly.
Very quickly.
All the time. Yeah, so it's been keeping up with it all, really, isn't it?
Yeah. I mean, I can't even imagine being in your office like every week there's a different announcement, something else.
Oh, it is. We just, I work closely with quite a few, Becky and Theataccounts, and we're on the phone all the time, and even, silly o'clock at night, right, what's this announcement? What does this mean for our clients? It's been quite a testing time for us.
I can imagine.
It's been crazy.
So just talk a little bit, I mean, if there are people watching now who haven't used an accountant before, haven't needed one, maybe in the 1920 tax year, suddenly earn lots of money and are unsure how to do it, or are recent graduates, they can talk a little bit about coming to you. How do they do that?
Yeah, so we're obviously an accountant set up specifically for the entertainment industry. It's really common at the beginning that people do their own tax returns, and actually it's not a bad thing because it gives you an insight in how a tax return works, and I've talked about the fact that it is ultimately your tax return. So that's really common that people do it themselves for the first year or two, and especially the cost element. However, at the point when you start having to pay tax, when payments on account start kicking in, all of those additional things that I've run through, that's the point then you probably would pay to have an accountant and have that support from the professionals, if you like. So we ultimately obviously love to have as many clients, anybody that wanted to join us. We charge between £225 and £275 plus VAT per return. So it's really, it's a, what's the word I'm looking for, Rosie?
Reasonable.
Yes, reasonable. Thank you. I've talked too much, my brain. I need some coffee. Yeah, so it's a competitive fee, and actually it's probably not as much as people think it might be. And then you really can just hand it all over and people can deal with it. So yeah, we're here for anybody who's got questions. My email address is here for anybody who still wants to do their own but need a bit of guidance, then we're happy to help. But obviously anyone who wants an accountant, then we're here.
Amazing. Natalie, thank you so much. I know you have literally talked for an hour and 20 minutes. So thank you so much. I know it's been massively appreciated. I'm just going to pop these on the screen so people can see. Yvette's just says thank you so much for the clarity. Rachel, thank you so much, Natalie. This session has been extremely helpful. Really appreciate your time. Melissa says thank you so much for doing these sessions, Natalie. They've been super helpful. Brilliant. So yeah, brilliant. Thank you so much. I'm going to take you out of the live stream. Thank you so much.
Thanks, Rosie. Bye.
In a couple of weeks. Bye.
Yeah,
bye. Brilliant, guys. Remember that this session will remain on the YouTube channel for another month. So if you want to come back and revisit, then you can. And as Natalie said, if you have any questions, you can write to them. And also, if you are looking for an accountant, those guys are, available. Just give them a call or shoot them an email. Coming up through the rest of the day, I'm just going to talk quickly about some sessions that we have. We've got Acting Through Song workshop with Grace Taylor. She is back again with Althea Bury. They will be working through an audition piece, and so available for questions and comments through that. So make sure you're joining for that. Katie Richardson is back with Further Music Theory. I know her Wheels of Fifths, I think it was Circles of Fifths, was incredibly popular last time. So she is back with another session. We're going to be losing Grace and Katie very soon to the 6 rehearsals for the drive-in tour. They'll be back later in the summer, but these are some of their kind of last in the series for us until 6 is up and running in August. M&M Jazz is back with a jazz technique class, so make sure you are joining for that. That's a brand new class, so if you've been enjoying their sessions, there's another one. And then West End star Leighton Williams is with us this afternoon at 5 o'clock, and we'll be talking through everything around his career, the highs and lows of the entertainment industry. As you know, we have been doing a series of interviewing various actors at different stages in their careers, and just, you know, talking about the industry and the very high points and then sometimes the low points as well. So Leighton is with us at 5 o'clock. Remember, guys, if you want to be interacting with the sessions, you do need to subscribe even to our YouTube channel. Also, make sure you're sharing the love on socials. We are at CCI 2020 on Twitter and at Collective Creative Initiative on Instagram. Make sure you are tagging in practitioners you really enjoyed. That today was Natalie from Theataccounts. So make sure you are giving them all of the love on social media. We'll see you back here in half an hour with Grace and Althea. Meanwhile, take care and we'll see you soon.